All right, I think we are live. First time going live on YouTube. I am Katie Card-Niedermeyer with the card team at American Pacific Mortgage, and I am here to answer some questions. I started doing kind of a question and answer forum last week, and I want to continue with that. So these are questions that I have fielded in the last week. These are actually questions that came from a realtor partner of mine. We discussed them earlier today, and so I want to share with all of you. They are great for first-time buyers. So I focus on helping coach first-time buyers. They're my specialty. I love helping with the process, explaining things, helping set goals in order to accomplish really set markers in order to accomplish the goal of home ownership. So what are we going to talk about today? We have 4 questions we're going to go through, and I am going to start with, these are all questions that are good for buyers, but especially first-time buyers and anybody looking to buy right now. So number 1, what is the difference between a pre-qualification, a pre-approval, and a full loan approval? So a pre-qual, I think of it as basically talking about numbers, right? It's kind of over the phone, giving information, right? What's someone's income? What are their debts? What's their FICO score, right? It's basically just taking that verbal information and then letting them know what they can qualify for. Now, whenever we do this, it's like there's like a big asterisk, because this is a pre-qual can be great for someone planning, right? I'm a year out, I'm 2 years out, I want to see what I can, ballpark what I can qualify for, but there's no actual documentation that we collect necessarily. So it's a first step in understanding where you stand, but it's not good when it comes to actually making an offer. Okay. Next would be a pre-approval. So what is a pre-approval? Usually we take a loan application, we run credit, and we run automated underwriting, which is our computer generated system that spits out an approval. Okay. Now that system does not have the ability to read documentation, and it doesn't have the ability to, basically it's reading a loan app and it's reading the information that is in there. And so it has to be super accurate. So the biggest thing with the pre-approval is it's not a full underwritten approval, but it is what most people get when they are looking to buy. The next best thing, and the best thing really, and what we encourage all of our buyers to have, is a full loan approval. We call that the ACE approval with our team or the card team. So we call it the ACE approval. You might have heard of it as a TBD approval or a fully underwritten approval. Basically, what that is on top of the pre-approval is it is also a human underwriter, human eyes looking at the file, or an AI system that can read documentation to really verify everything. A lot of times it'll include a verification of employment as well. So in this competitive market, if you're making offers, you want a full loan approval. And again, it's what we suggest for all of our buyers. Okay, on to the next question. How and when do you lock an interest rate? So there are a lot of people coming to us right now saying, I want to buy in the summer, or maybe I want to buy in the fall. And what does that mean for interest rates? And we're going to talk about what interest rates are doing in a second. But the important thing to understand is we do have the ability to lock interest rates in advance. However, there is a cost, and there's only a certain amount of time that we can lock those interest rates for. So in most cases, we are actually, and one, hard thing about locking the interest rate in advance is if you don't really know when you're going to get an accepted contract, it's very difficult to do that. In today's market, if you're making, 5 or 6 offers, you don't know when the right property is going to come along, and you don't know when you're going to get your offer accepted. So locking in the rate in advance and paying up front is very difficult. Most people lock in the interest rate when they have the accepted contract. So you've made an offer and the seller has accepted your offer, and now escrow opens, that time, frame that you have. Usually it's about 30 days, sometimes less in this environment. And so during that time is when we lock. Okay. Right? I'm committed to this property. So during that time, we'll advise our buyer on what's happening in the market. Should we lock this week? Should we lock this day? And we give them all the information, and then, allow them to say, okay, let's move forward, or let's wait. Okay. So when do we lock? Typically we lock when you have that accepted contract. Next question. What is happening with interest rates. This is a big topic. I'm sure you have seen if you follow, if you read the newspaper, you read the news, you're going to probably be seeing, information on this and what's happening. So first, I want to back up to about 2 years ago when COVID-19 started, or I should say became an issue, started to impact our economy, right, in early 2020. In order to stimulate the economy, the Fed rate, dropped very low, close to zero. And the Fed rate is the target interest rate set by the Fed at which banks borrow and lend their excess reserves to each other overnight. Now, this doesn't directly impact mortgage interest rates, but it impacts a plethora of other parts of the market that in turn impact our interest rates. So the other thing the Fed was doing is they started buying a higher than normal amount of mortgage-backed securities to help keep interest rates low. So basically, more bonds are bought, which increase their value, and thus keeping and really decreasing mortgage interest rates. So now the Fed is selling off those bonds, which is impacting rates. There are also other factors like inflation. Because the Fed rate has been so low, they're increasing that to help cool inflation. The Fed has announced last week that there should be 3 Fed hikes this year, which is going to impact, borrowing, lending, and economic growth. So there's a lot of things that are going to be impacted by that. We don't really know how fast or exactly how much rates are going to increase, but likely they are going to go up. We're going to see them rise. We already have. In the last week, we've seen the highest interest rates in 2 years. So, bottom line, what does that mean? It means if you're buying, that you just need to make sure that you're keeping up with where rates are, because it's going to lead into our next question, which is, how does that impact affordability? Well, if interest rates were at 3.25% when you were getting qualified or pre-qualified, pre-approved, whatever it is, right? And now they're at 3.75, that could increase your payment by $200, right? So for a half point increase like that at about a $750 loan amount, that's about $200 a month. Okay. So that could make the difference, or, that could really impact you from even being able to qualify for the loan that you want. Now, some people ask, do most borrowers borrow at their max loan amount? Not always. I mean, it really varies. Every borrower is different, but a lot of times, especially in a competitive market, when you're getting outbid or you're needing to, come back with a counter offer, people do get higher in the offers that they're making. And so you have to be ready to go higher. So going in and starting at your max loan amount is not going to be helpful. Or it's not going to be a good place to start. And especially if you know that we're in a rising interest rate environment, you're not going to want to start at your max. You're going to want to start lower. So hopefully all of these things are helpful to you. If you ever want to reach out, you can always find us at card-team.com, or you can follow me on Instagram. My handle is Katie Card Niedermeyer. So my full name. And if you know how to spell that, I will also put it in the notes. So have a fabulous rest of your week. And thanks for being here.